This is the CRE Weekly Digest by LightBox, a firm transforming the commercial real estate landscape by connecting every step of the CRE process with comprehensive tools and data. I'm Martha Kocher with our experts Manus, Clancy, and Dianne Crocker. For the week of November 4th to the 8th, stocks soared across the board on the news of a Trump election victory as investors anticipate a pro-growth agenda of lower taxes and deregulation. And as expected, the Federal Reserve cut interest rates by a quarter point, but Fed watchers were more interested in the press conference for clues of what's to come. Manus, there were no surprises in the Fed decision, and Powell stayed pretty much on script, saying the FOMC would be data dependent.
Yeah, I think the consensus was no surprise, although I was a little surprised, I have to say. I know Dianne in the past has been calling for a 25 basis point rate cut. The Fed came through with that today on a rare Thursday afternoon meeting, right? That ended today. Normally they end on Wednesdays. This is kind of a unicorn in that regard. But I was a little surprised. And I was surprised because after the 50 basis point rate cut 6 weeks ago, almost 2 months ago, we've seen nothing but long interest rates climbing. We can get into that a little bit more, why that may have been the case over the last 2 months. So I thought there might be some hesitance on the part of the Fed this week to do that. And then we saw the really explosive rally in stocks yesterday, and then again, to a lesser degree today, that I thought the Fed might say, people are getting a little bit carried away with this, right? We're seeing a little too much euphoria in the stock markets, a little bit too much pain in the long-term treasury market. Maybe this is a wait and see moment. So color me a little bit surprised by the decision, but I think I was an outlier in my expectations.
Yeah, I mean, for me, Manus, I'm with you, Martha, I guess is the right way to say it. That today's chess move was widely expected, and in my mind, I'm thinking what's next? Because last week and pretty much throughout all of October, everybody was saying, okay, there'll be a quarter point cut in November and another one in December, and then a string of further reductions in 2025. Now we have a decisive win by Trump. So the question in my mind is now what? The jobs market is relatively strong. Consumer spending is still pretty strong as we head into the retail-centric holiday season. And I think certainly the commercial real estate market's hope is that the election results won't impact monetary policy and plans to bring rates down, since it's, we're early in the cycle. It's just starting to help the numbers work a little bit. And the math is working better than it has over the past few years. So, we just started down this path. Will we stay on it? What if Trump's tariff plan triggers inflationary pressures or the labor market worsens? So I'm excited to talk about that now that we know who the next president will be.
One of my real concerns, and I haven't verbalized it, I don't think, at all since we started this podcast back in June, or if I did, it was rare, is what Greenspan coined the wealth effect 20 years ago, maybe even 30 years ago, where he said, when asset prices are up, people feel good, they spend more money, that spending is inflationary. And I guess that's really what I'm getting at right now, and what I've been hinting at but not verbalizing for several weeks, is that when you have a stock market that's soaring, when you have housing prices that are soaring, people feel better about what they have. They feel wealthier. That is the wealth effect. When they do so, they spend more money going out to dinner, on family vacations, and other things, and that is inflationary. And I think that's why I've been such a skeptic about the Fed being aggressive in cutting rates. I think it's a great thing for the commercial real estate market, and that's what we do. So I do feel good for the listeners of this podcast. I do think that it's a real welcome turn there. But for the rest of the economy, it wouldn't shock me at all if this wealth effect, lower interest rate, drawing more people into equity investing, people's 401ks getting boosted, that has a reverberation and pushes prices higher. That's my 2 cents. I may be an outlier on that point, but it is my most immediate concern today with this, second cut that we've seen now in 3 months.
So we're going to spend some time talking about the economic agenda of a Trump 2.0 presidency. And we've got the benefit of history because he's been president before. And we've got the benefit that he's given us some very specific outline of what he plans to do. So let's walk through some of that. We had David McCarthy from CREFC on our podcast a few weeks ago to kind of help us game out the risks and the opportunities for different scenarios. But now we know the scenario pretty much, and we can walk through that. And the sentiment is that a Trump 2.0 presidency will be better organized. They've got already an idea of who their staffers are going to be. They've got the Senate and potentially the House and a Supreme Court that's aligned. So in many ways, a president that has a lot of ability to get an agenda acted upon.
Well, before we get into the agenda, I do want to say one thing to the entire audience, especially for people that are under the age of 40. And this comes from somebody who has seen, I don't know, a couple dozen elections, I guess, at this point in my life. And one thing I can assure you, and I've been talking to my kids about that. I have 5 kids. Some of you may know this already. They run the gamut from very, very progressive to very, very conservative. So I knew that whatever happened on Tuesday night was going to disappoint some of them. There's that old adage, you're only as happy as your least happy child. So knowing that 1 or 2 of my kids were going to be unhappy no matter what, tempered whatever enthusiasm or disappointment I may have had that night. But for those people that, think that the future hinges on this moment, at the end of 4 years, if you were happy about what happened on Tuesday night, chances are you will be disappointed that Trump couldn't get done nearly as much as you thought he might. And on the negative side, if you were despondent on Tuesday night, let me assure you that if you think he's going to run the table and get everything he wants, it's just not going to happen. It's just not the way this country functions. We have checks and balances. And for those that are disappointed, it won't be as bad as how it might have felt on Tuesday night. And for those that were happy, it's not going to be as good as you think it might be because it just doesn't work that way.
I love that perspective, Manus. And you have among your kids kind of a little microcosm of the US voting public, which is great. I'll start out by saying that I'm glad it's over. I was starting to get tired of writing the sentence, given the election uncertainty in November, and now I don't have to do that anymore. And I think regardless of how you feel about the election results, to your point, at least we have certainty, and it's not a contested election that will drag into weeks or months of chaos about who won. I think from the perspective of the market, that would have been the absolute worst outcome. And instead, we have a decisive win, and we can have conversations like we're about to have about what it means in terms of tariffs and taxes and the housing and labor market and construction. So let's get at it.
So we've got a lot to cover. Let's start with, we've got tariffs, taxes, and a lot more. So let's start with tariffs.
The tariff thing is an interesting one in that, it does seem to be in the top 2 of what Trump wants to do. It's a concern. There's concern about inflationary pressures, upward inflationary pressures. There's concern about retaliation. There's concern about things becoming even less affordable now or in a couple of years than they are now, more money taken out of people's pocketbook. I get that. What I don't know, what nobody really knows, is how much of this is real and how much of it is posturing, pre-negotiating, things like that. My hope is that Trump uses this tool strategically as a vehicle to bring people to the table to get more out of negotiations, trade negotiations, than we've gotten in the past. If that's the case, if he doesn't hammer people with 60 and 80% tariffs, if it's just a negotiating tool, then great, right? If we can get better trade deals that help us keep more employment here in the US and benefit the United States, great. If it's scorched earth, it's probably not great. So, but I think time will tell, and we just don't know.
Yeah, you might be right that he would use that as a strategic tool. I think certainly one obvious concern is if he did go through with the proposed tariffs, that it could raise inflation, which would affect the Fed's path for future rate cuts. And the tariff plan obviously has implications for retail. I heard on the news today, the National Retail Federation reported that U.S. retailers are already planning to bake in increases on goods from China. So, that could mean a continuation of the trend we've talked about on the pod before, which is consumer spending is up, but consumers are more cost conscious. So if goods from China are going up, that could drive demand for real estate from more like discount retailers. as they expand to meet consumer demand. We'll see.
I mean, the good news out of it is politicians generally aren't stupid or they're not unwilling to pivot if they've made a bad decision. Martha's looking at me with crossed eyes here, like, I'm not sure. Some of them may be stupid. But, I hearken back again to the 90s. I don't know if you remember this, but there was a tax bill put through that people thought it was a good idea that we would tax luxury goods at a really high level, that we were going to tax boats that were costing more than $30,000 with an extra 5% or something like that, Mercedes and BMWs. And I think it was under Clinton that this thing passed, but I'm not 100% sure. But what quickly happened was boat makers in Massachusetts were going out of business. People said, forget it. It's now too pricey for me to buy a boat. That extra 5% is making me not need a boat. I'll pass. People were getting laid off. Very shortly thereafter, the tax hike was rescinded and the boating manufacturing business in Massachusetts was restored. And it just goes to show that politicians will pivot when they see their constituents have pain. And I do think that if Trump were to go scorched earth and do something, and that led to complaints nationwide among his voters that car prices are 10% higher, tire prices are 20% higher, other utilities, other durable goods are more expensive, I think he would pivot. I don't think he's so much of an ideologue that he would put something in place that he wouldn't walk back from if the pain was too great. Let's hope. But like you said, Dianne, time will tell.
Yeah. And I want to jump on one other thing that you said earlier, Manus, which is if he uses that as a strategic tool, the tariffs, if he uses tariffs as a strategic tool, the upshot might eventually be that more U.S. manufacturing stays here. And that brought to mind something that Spencer Levy at CBRE said recently, which is one of the megatrends in commercial real estate is that investors are starting to position and migrate toward hubs of manufacturing across the U.S. So if U.S. manufacturing increases, then I expect one impact of that on commercial real estate will be to boost demand in areas that really kind of see a boost in development as a result of that around some major manufacturing hubs.
Well, I think we can look at history as an example. So in 2018, when they applied tariffs to China, China obviously responded, but they also started sending some of their goods to Vietnam to be exported. So if it isn't a broad brush tariff and you do allow for some differences in how you apply tariffs, you could have, say, Mexico, for example, be a location where China starts sending some of its manufacturing and some of its goods to be exported.
One of the benefits of having seen a Trump presidency before is we know that the steps he took didn't decimate any industries, and he was somewhat flexible in his approach to this. Let's hope that that same logic applies in TV too. Should we call it that? Trump version 2?
That sounds good. And, one thing that we haven't talked about yet, because we haven't talked about housing, is construction costs. So almost anything having to do with construction is often brought in from a number of different countries. When tariffs were applied to Canada for lumber, we saw lumber prices skyrocket in 2021. And then, of course, you had the post-pandemic supply chain gum up that made that even worse. So things like steel, aluminum, lumber, all of those things that in many cases, American producers can't fill the gap fast enough would be a problem.
It certainly would be a problem. I guess the good news is that housing costs, housing unavailability, lack of supply, and the prospects for young people being able to become homeowners has been so front and center for the last couple of years that I'm hopeful that it made an impact on the president-elect, and that that will go into the calculus as he's having these conversations, that it will result in something that is not scorched earth, that is tactical, strategic, surgical in its approach, and doesn't have that impact where prices, which are already sky high in many markets, go up another 10 or 20%. That would be a black mark, I think, on a second Trump presidency.
I also think that perhaps part of the thinking on tariffs is to help fund some of the tax cuts that are in his plan.
The tax cuts are really curious, I have to say. I mean, politicians will always say whatever they have to get elected. Trump put out some really bold but expensive initiatives, right? No taxes on tips, probably not that bold, probably not a bad thing, right? The people that are working off tips are at the lower end of the economic pyramid, probably not a terribly expensive thing to put in place, probably a good thing. But when you get to no taxes on Social Security, that's a very, very expensive thing. You're talking about a program that already eats up an enormous amount of revenue, government transfer funds, and to put more stress on the system by making that tax free, I think just completely explodes the deficit. So I think that as with tariffs, I think the devils are in the details. If I were Trump, if I were advising him, if you were going to listen to me, imagine that, Donald Trump listening to me, I would say focus on bringing prices down, focus on things that can put more money in people's pockets by making housing more affordable, make interest rates lower. How do you make interest rate lower? You cut the deficit. How do you make housing more affordable? You put policies in place that allow more of it to be developed, that people can do this quicker. How do you make housing more affordable? You make it so that materials going into them don't become part of a trade war. So if it were me, I'd say, set that Social Security thing on the side as much as people would be very happy with it and focus on things that make the U.S. economy stronger, cutting our spending, lowering interest rates, lowering barriers to entry, trying to keep Americans fully employed. That would be my advice. When he picks up the phone, when he picks up the orange phone and he says, Manus, what do you think?
Yeah, Manus, you might be opening the door for yourself to a position in the new administration.
Well, it's funny that when Martha and I were doing this in an earlier career podcast, we did get a call from the Trump organization at one point just to pick our brains and say, hey, what's going on? We love listening to your podcast. It wasn't the Donald. They even sent us a 6-pack of Trump wine, which was interesting, I have to say. I'm not sure I ever tried it. I don't know. Is Trump wine any good? I think it was red.
It's a 6-pack?
Well, it wasn't like a beer 6-pack. It was a box, right? Whatever you get at the liquor store, they give you the box because it's too big to carry out in bags.
Another topic is housing. And what does that mean for this sector? You might have heard Trump on the campaign trail vowing to lower housing costs. And at a recent rally in Arizona, he said that he was planning to drive down the 30-year mortgage rate to 2% to help average American homebuyers. But the 30-year rate inched up to an average 7.13% after he won. And one thing I saw was Mike Brattantoni, the chief economist at the Mortgage Bankers Association, and hopefully I didn't just mangle his name, said a second Trump administration could stoke a higher level of growth for the U.S. economy, but that also brings with it higher inflation and higher interest rates.
You really can't separate the two, can you? If Trump succeeds in making the U.S. economy more efficient and GDP grows to 4%, 4.5%, 5%, it's almost impossible for interest rates not to be dragged higher. Higher economic activity means higher interest rates. They almost never diverge, right? And if they do diverge, it's usually in the other way when you have stagflation and you have high interest rates and low growth. You never see high growth and low interest rates. So for him to say that, it's, I put it down into another bucket of people promising something that they really can't deliver. The only way that this could be possible would be if Trump were to stoke growth to some degree, but if he were to slash spending to such a degree that the deficit started to shrink. We started running surpluses. The $35 trillion US debt started to reverse and go lower and lower and lower. If you're going to reverse the deficit, that's a decade or 2-decade or 3-decade process. You don't make that kind of impact in a 4-year window. So count me as skeptical to his ability to get interest rates down to 2% unless he fails and sends the US into a recession.
And we already talked about construction costs. One thing that is a big factor in construction costs is labor. And one of his big policy promises is to deport millions of undocumented immigrants, which obviously would shrink the labor supply, many of whom are working in areas like construction and agriculture. So that might be an additional pressure in that segment.
Again, I guess I would say here, color me skeptical about whether this will happen. I certainly agree that if we were to be deporting millions and millions of people, that labor costs would drive higher, whether it's undocumented or documented immigrants is a low-cost source of labor for builders, and it's been there for a long time. To reverse that would send prices higher, no doubt about it. My expectation is that none of that happens, that there isn't this mass deportation, just as the rhetoric took us to a 2% mortgage rate, to a golden age of the US economy, to 80% tariffs, and now deporting millions of people. I think the reality will come down to this. It will be considerably harder to enter the US, that we will have more stringent rules for getting in here, that will reduce the flow of people coming in, which is also inflationary for labor, no doubt about it. But I also think that this will be selective deportation. I think that for people that have been here, that are working hard, that go to work every day, that just try to put food on their family's table, which, by the way, represents probably 98% of the people that come here, they have no problems. They are going to continue their day. That's my hope and that's my expectation. And the 2% that run afoul of the law and do bad things will be rapidly deported, whereas they haven't been in the past. And that's what I think the change is. And I hope that that's the way it is, because I do have children, I mentioned this at the top, that are concerned. And I said to them, I don't think you need to be concerned about your neighbors, because even people that are on the right-hand side of the spectrum would fight to defend their neighbors that are law-abiding and whose kids trick or treat in the neighborhood and go to their kids' schools and stuff like that. I think Americans have big hearts, and they would stand in the way of injustice if that kind of injustice took root.
Martha, one of the things that you brought up before is this is Trump's second, or will be his second term in power. So it gives us the benefit of looking back at what he did previously as we kind of opine on where things will head. So when he was in office from 2017 to 21, his appointed Federal Housing Finance Agency Director, Mark Calabria, saw a quick end to governor conservatorship of Fannie and Freddie. And then that policy took a really dramatic turn under Biden's director, Sandra Thompson, who wants to merely exit conservatorship when the GSEs are ready and is committed to achieving their affordable housing goals. So, it'll be interesting to see what's going to happen with this. Trump has certainly indicated that in this term, he would move to exit the GSEs from conservatorship, likely via administrative action.
One area that a number of people feel pretty optimistic about is regulation. And you saw the banks respond positively post-election, and essentially the sense that a deregulatory approach is going to be good for business overall.
One thing that's top of mind is Basel III and what the fate of that will be. Basel III's proposal would have required banks to hold 9% more in capital in aggregate. So I think it's, I don't think it's going out on a limb to say that Trump presidency would likely stall or scrap the endgame proposal altogether. So I think, banks would be happy about that for sure.
Well, of all the things that Trump comes into office with in terms of the promises, the two things that I can get behind the most are a reduction in government spending. The truth is, any kind of reduction is a good one, but it certainly doesn't move the needle a ton. Most of this country's expenditures come from the military, Social Security, and Medicare and Medicaid. If we could get rid of wasteful programs, if we could, just change the metrics by which we spend discretionarily, I'm all for that. And the second one is the one you were just bringing up, Dianne, which is the regulatory, that we want the wheels of progress to function quickly. right? We don't want it to take 20 years to build a nuclear power plant. We don't want to have red tape that keeps us from building our housing, especially our workforce housing supply. Those types of things I'm all in on, that if we can make this better, it helps people, at the bottom end of the economic triangle, which I think is where you and I and Martha would like to see the most progress made.
An area of stark contrast between the two administrations is climate change. Under a Harris administration, things like climate change and sustainability were a large part of their agenda. So, under a Trump administration, I think we're likely to see little or no focus on climate change, sustainability, ESG, and instead, that will move down to the state level. So we'll see more progressive states like New York, like California, move to enact aggressive standards that other states might adopt on things like disclosure, on things like New York City's greenhouse gas emissions law.
And I recall when we spoke with David McCarthy about the election, a lot of things he said would be happening are at the state level. We saw two propositions in California make some serious change in that state, and it essentially is a pendulum swinging the other way. Californians voted to increase punishments for repeat theft and drug crimes by approving Prop 36 by a pretty wide margin. And Manus, I know previously we had talked a number of times about retailers leaving, pulling up stakes, closing stores, getting out of San Francisco. And one of the sad stories is the Union Square neighborhood, which used to be a shopping mecca for tourists and locals with a number of different stores, including Nordstrom and Macy's and others. And essentially, most of those just closed up shop.
Of all the things that came out of Tuesday's election, some of the best news came out of California, without a doubt. That referendum, I think, passed by 70-30, pushing punishments up. Make no mistake. I mean, I know that when these laws were written, they were done with a thought of good intentions, right? Let's reduce the number of minorities incarcerated for minor crimes. It's been a problem for a long time. I get the whole notion, I get the whole good intentions thing, but the reality was it took a big bite out of the neighborhoods of the least fortunate among us. Higher crime, fewer stores operating, pharmacies pulling out of those areas. It was just an idea that wasn't well thought out. And as we go forward, hopefully this means that retailers come back to neighborhoods with marginalized populations, that they get grocery stores, that they get pharmacies coming back, that there's less crime, that people want to live there, that the economic velocity picks up, right? That's who we're all rooting for. There used to be an expression, I think it was a Grateful Dead thing, right? When they were trying to keep ticket prices down and scalpers out of the market. Nobody wins unless everybody wins. And that would be the way to think about things, right? By no means do I mean that people in marginalized groups should be over penalized with harsher sentencing or anything else. There's a middle way, right? There is a middle way, which is keeping neighborhoods safe, yet treating people fairly.
And the other local legislation was Prop 33, where California voters basically turned down the ability for the government to enact rent control measures, which was a reversal of where they were headed.
You may not be able to hear it from where you're sitting right now listening to our podcast, but the roars from the crowd on Tuesday night were from developers, people that wanted more housing to be built. Rent control, rent stabilization is the bane of housing supply. It's been a bad policy in New York for decades. If it took root in California to a bigger degree, it was going to mean housing displacement got even more, housing got less affordable, less supply. Incredible satisfaction that this went down and that the people of California will not have to endure what people in New York have been enduring for decades.
And it would have had implications for tax revenues. Apparently, tens of millions of dollars would likely have been on the floor if this had gone through.
And it wasn't even close. It was 62% opposed to 38 supporting.
believe it or not, with all this news, we did release the CRE Activity Index, which had an interesting turn from the last month. Dianne, what happened?
Yeah, before we get to that, I do want to take just a moment to thank one of our listeners. This is a Valentine for you, Manus and Martha, even though it's not February. Ben Bremer is the president of LCS. And for those of you who don't know LCS, they're Lender Consulting Services. They're based in Buffalo, a longtime client of LightBox. They offer a range of environmental, construction, and appraisal due diligence to banks and REITs and private lenders. Ben is also a member of the LightBox Market Advisory Council, which means that I bug him every quarter to tell me what he's seeing in LCS's markets and how he and his clients are feeling about the market. So Ben reached out this week as a listener to say that he appreciates our pod in these confusing and uncertain times. So thanks for that, Ben. We really appreciate it.
Well, let me say, Dianne, there's no reason why you still can't circulate those chocolate things with the nougat inside, with the hint of strawberry flavor. Those are good, not just in February. So, when Martha and I will certainly take a heart-shaped chocolate, even though it's not winter.
Well, would you prefer a compliment or chocolate?
Chocolate.
All right. Well, Manus, you can go ahead and pat yourself on the back because your prediction in last week's pod of where the October LightBox CRE Activity Index would land was right on the money. For any listeners who haven't seen the CRE Activity Index, it's our aggregate index of overall velocity of commercial real estate, and we draw it from a mix of measures across our platforms on functions that are leading indicators of deal making, and that includes properties brought to market, environmental due diligence, and lenders' appraisal activity. The index in September was 98.2 after a strong 8-point jump in anticipation of the first rate cut. And our October number did exactly what Manus expected it to do. It showed a minor dip. It landed at a still strong 95.9, and it was well above last October, which was down at 79.7. So the dip that Manus predicted was neither surprising nor concerning, and that was for two reasons. One was we typically see the index contract a little bit in October after an August to September uptick after a summer lull. And September's increase this year was even stronger than usual, largely because folks knew that the Fed was going to cut rates in September. And then number two, while October did deliver another round of the 9-digit transactions that you follow, Manus, and a healthy round of leasing, I think there was kind of a general sense of wait and see with the November election right around the corner. And I think that and things like the elevated 10-year treasury were really kind of giving some investors a reason to just pause a little bit. So, we'll see. November's activity index will reflect how the market is starting to respond to finally having the election uncertainty receding in the rearview mirror. And now we have today's rate cut on the books, of course, too. And one last thing I wanted to mention was that last November led to December's 4-year low in the index. Last December, the index hit a low of 48.2 versus what we just got for October, 95.9. So even if the index stays relatively flat through year end, that'll be a dramatic improvement over where we were at the end of last year.
A couple thoughts on that very briefly. It wouldn't surprise me if we saw another dip in November. We have seen the yield on the 10-year jump from about 4.2% to over 4.4 with the Trump election and with the euphoria in the stock market that came with it. So that may cause a timeout. I think you're right on, Dianne, about possibly for the first week of November, we see a slow in transactions because people were watching the election. But I would want to point out, I'll tease a blog we have coming out very shortly, and that is we've been following the number of $100 million sales and higher every month. How many are there as a indicator of market activity? And for several months, that number was usually around 25 to 30 transactions in a given month with a 9-digit check being written or higher. In October, even with the higher interest rates, there were 53 transactions where the price tag was 100 million or up. And I think that that's an evidence of animal spirits starting to pick up a little bit. So a little bit of a contrary indicator last month compared to the index.
And our Did You Know for the week. we analyzed the mix of property listings by major asset class. And what did we learn?
These are from LightBox's RCM platform. So we went back to 2019. And as a percentage of total, property listings have been fairly constant for industrial and retail, but the share accounted for by multifamily rose from 23% in 2019 to 34% year to date this year. And the share of office fell from 20% 5 years ago to just 10% this year.
I know you guys talked about you're kind of happy that the election season is over. Dianne, any big takeaways for you?
Well, I'll share a fun fact I heard this morning on the news, which was the price tag of campaign ads in all elections, federal down to very local, was something like $10.5 billion. And that was $1 billion more than the election 4 years ago.
It's an extraordinary amount of spending. I, for one, will be grateful that the spigot is turned off, that we can watch football or other things without the inundation. People joke with me, hey, buddy, you're in South Carolina. You must be spared. It's not a contested state. And my retort is, I'm about 30 miles from North Carolina and 30 miles from Georgia. You can imagine how brutal the last 6 months have been. So I'm happy that that spending is being turned off.
With that, we'll close. Thanks to our producer, Josh Bruning. Please join us every week as our Lightbox team shares CRE news and data in context. You can listen on any of your favorite podcast channels and send your comments or questions or Valentines to podcast@lightboxre.com. Thank you for listening and have a great week.
Let's go.